Ladies and gentlemen, good day and welcome to the earnings conference call of Vijaya Diagnostic Centre Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you and over to you.
Thank you. Good afternoon everyone and a very warm welcome to Vijaya Diagnostic Centre's Q2FY23 earnings conference call. We have with us Ms. Suprita Reddy, Chief Executive Officer, Mr. Sunil Chandra, Executive Director, Mr. Narasimha Raju, Chief Financial Officer, and Mr. Shiva Ram Raju, Head of Strategy of the company. We would like to begin the call with opening remarks from the management, followed by an interactive question and answer session. Before we start, I'd like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Ms. Suprita Reddy to make her opening remarks.
Thank you. Good afternoon, everyone. I'd like to take this opportunity today to welcome each one of you to this forum on behalf of the management team of Vijaya Diagnostic Centre Limited. I will first present the key highlights for the period, after which Mr. Narasimha Raju will take you through the operational and financial highlights of the quarter and half year ended 30th September 2022. The second quarter saw a healthy improvement in the demand for non-COVID business across all segments. The company managed to enhance its network and make considerable progress on its calibrated expansion plans. The wellness business is showing positive results and the company continues to increase its revenue share from this segment. During Q2FY23, the wellness segment recorded its highest ever contribution to revenues at 12.4%. This being the case, we are quite sure that the integrated diagnostic service providers derived major business from B2C will not be influenced by competition of different formats. I'm glad to announce the commencement of operations of a one-of-its-kind center at Panjagutta. This center is spread across 16,000 square feet. The facility is the first in South India to introduce a walk-in, walk-out dual-source cardiac CT and a biometrics 3 Tesla MRI, apart from advanced imaging equipment such as a PET CT and gamma camera. During Q2FY23, we successfully commissioned one hub at Rajahmundry and 12 new spoke centers. A few of these spoke centers were set up to capture upcoming pockets across Hyderabad. This helped us ease up existing centers in the region facing capacity constraints. These spoke centers also strengthened our hubs and contributed to positive growth in volume. These small-sized spoke centers are over and above our initial plan of expanding by 15 more centers in FY23. I'm also happy to share that we have recently migrated all our centers and labs across the network to a more efficient, robust and comprehensive ERP that will enhance operational efficiency, enable construction of useful and informative analytics, facilitate an interactive customer interface, help engage the customer and make the entire experience more complete and wholesome. We are determined to stay committed to our systematic strategy and business initiatives which we believe will enable us to grow and strengthen our brand in our key markets. We will continue to intelligently expand into profitable Tier 2 and Tier 3 cities across home markets and untapped adjacent geographies. The promising dynamics of the Indian diagnostic sector, coupled with our innate capabilities and that of being a trusted brand of choice, will surely enable us to maintain steady growth in time to come. With this, I would like to hand over to our CFO, Mr. Narasimha Raju, who will take us through the operational and financial highlights for the period. Thank you.
Thank you, madam. Good afternoon and warm welcome to everyone joining us on the call today. I will briefly take you through the company's operating and financial performance for the quarter and half-year ended 30th September 2022. The consolidated revenue for the quarter stood at 121 crore as against 113 crore in Q2 FY22. During the current quarter, the company continued to witness month-on-month improvement in non-COVID test volumes. Also, the transition in the revenue mix profile from COVID to non-COVID continued in the current quarter as well. The non-COVID business revenues stood at 117 crore, comprising 97% of our revenue share as against 90% revenue share in Q2 FY22. Overall, our non-COVID business registered a growth of 15.1% year-on-year, while COVID revenues registered a decline of 67.6% on a year-on-year basis. The number of footfalls stood at 0.85 million as compared to 0.87 million in Q2 FY22. The number of tests registered a year-on-year increase of 11% from 2.36 million to 2.63 million. The number of tests per footfall has also increased to 3.09 in the current quarter from 2.72 in the last year Q2. The revenue per test was 459 rupees and revenue per footfall was 1418 rupees during the current quarter. EBITDA for the current quarter was at 49 crore as against 51 crore in the corresponding previous period. EBITDA margin stood healthy at 40.4%. Higher non-COVID revenues, the test volumes coupled with the operating leverage assisted us to achieve EBITDA margin of above 40%, despite the cost incurred due to the recently commissioned centers. The profit after tax for the current quarter stood at 23 crore and the surplus cash balance amounted to 249 crore as of September 2022. I will now summarize our performance for the half-year ended September 2022. Consolidated revenue stood at 225 crore as against 235 crore in H1 FY22. The non-COVID business comprised 97% of our revenue share as against 82% revenue share in H1 FY22. Our B2C share stood healthy at 94% in H1 FY23. EBITDA stood at 89 crore as against 108 crore in the corresponding previous year. EBITDA margin stood at 39.4% and the profit after tax was 41 crore. In conclusion, I would like to say that both the internal and external factors bode well for Vijaya's growth, and we remain confident of delivering consistent performance going forward. This brings me to end of my address. I would now request the moderator to open the line for the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Ashita Jain from Nuvama. Please go ahead.
Hi, good afternoon. So I have 3 questions. Firstly, Raji, could you help me with the growth rate 3-year CAGR for this quarter, that is from Q2 FY20 to Q2 FY23 on the non-COVID side?
So Ashita, maybe I see we roughly grew at a CAGR of 8.5%. Okay, but that's not the correct number to see, because in 2020, specifically in Q2, there was an dengue outbreak in Hyderabad. That particular year, in just Q2 itself, we roughly did about 90 crores of revenue, which was a high on dengue and malaria testing. That point in time, we roughly got about say 10 crores of revenue from these segments, which is not the case in the current year. So even with that, if you see, we've roughly grown at 8%, 8 to 8.5% CAGR.
Sure. And since we're already in the month of November, and you mentioned that we are growing month on month, just wanted to understand your take on the seasonality of the Q2 and how the volumes picking up in October month.
So like we mentioned earlier, for this particular geography, Q2 and Q4 are pretty seasonal in nature. The name Ashita. So typically we do see that Q1 and Q3 are more healthier quarters down here. And looking at the actually, if we do see Q2, we've seen a lot of fever packages and a lot of more of basic radiology, wellness business do well. So that's a good sign, but we should always keep in mind that Q3 is going to be seasonally a little probably a lower quarter, and Q4 again will be a better quarter for us.
If you secondly on the Panchagutta and Rajahmundry, I think it commenced both the centers now. And I understand your peak revenues will take time, 2 to 3 years. But your fixed cost is already hitting the P&L. Is it possible? Could you quantify the OPEX from just these two facilities, which is currently in our P&L this quarter?
So, Ashita, as we mentioned earlier, the large format centers, commission now, both the Rajahmundry and Panchagutta, like Rajahmundry commissioned in August, and then Panchagutta recently. But from last 5 to 6 months, a few of their costs are sitting in the P&L. So if you come to a number, roughly like 0.9 to 1% of the EBITDA is impacted because of these costs coming from these two major centers and also a couple of smaller format centers also. But these two centers form the major number out of the total fixed cost sitting to the P&L.
Just to add to that, it's also because of the advanced and very high-end centers. We also do that because we invest in people. You're getting the best-in-class technology, but you also want to make sure that they're trained and the centers are ready to take on a load. And keeping that point in mind, we still say that normally the break-even happens as per 3 quarters is what we say, but we also make sure that we keep in mind that this cost is there for about 4, 5 months, 6 months in advance, because this is what is going to drive the volumes in these centers going forward. And it's just, in fact, today is the exact 3rd month anniversary of Rajahmundry, so 1 quarter completed there. And Panchagutta has just opened, very large center with very advanced technology, so training is a crucial part there.
Yes. Thank you. And lastly, on your app, so any update on your digital app and the digital initiative?
Yes, Sajda, like I mentioned in the speech, the lab information software and the ERP have just gone live on 1st of November. So they are in a state of stabilization at the moment. In fact, we did it all together in one go. So probably give it a month's time for the links to settle in, and then we release the app. The app is absolutely ready at the back end, and the app and the website will both be in line once we release the app, probably December 2nd week or so.
Sure, thank you. That was all from my side.
Thank you.
Thank you. We have our next question from the line of Prakash Kapadia from Anivet Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. As we are adding 15 locations and, we are trying to move beyond Greater Hyderabad, could you give us some sense, what could be the pricing difference in the smaller towns versus a local player by us? And down the line, is the strategy to, get basic pathology services first in, some of these tier 2, 3 towns and then get them to move to radiology and ensure stickiness? Is that the plan in tier 2, tier 3, or it is just a pathology focus which is enough for us to grow?
So like we mentioned earlier, we normally go with the concept of going in with a large format hub first. So it's never just pathology. In fact, it's a large size center, about 6,000 to 10,000 square feet with both pathology and radiology. And once that stabilizes, then we start adding the spokes. It's never been a strategy to go with only pathology or a B2B kind of a business model into any geography that we go to. And the second thing is definitely there is a pricing decrease in these tier 2 and tier 3 places. I think it should be about 10 to 15% lower than what would be the charge that we do in the core Hyderabad market.
And the pricing in these, smaller towns and cities, how would they compare it with, say, a local player?
It would be comparable, and that is why it's about 10 to 15% lower, because in fact in Hyderabad itself we are pretty affordable, and we are more or less priced at the unorganized sector level. So that is why you're seeing only a 10 to 15% lower gap there in your tier 2 and tier 3 cities.
Understood. In Hyderabad, what is the sense you are getting from new age players? Has, pricing pressure remained same? Have, prices increased? Have prices decreased, or it's status quo? Any sense from competitive landscape in Hyderabad?
So we are not able to
hear you at all.
I was trying to understand about competitive pricing in Hyderabad. So is pricing pressure increased from new age players? Is it same? Is it decreased? What is the sense of pricing in the Hyderabad market?
So, Prakash, if you see the average revenue per test in the Q2 also, right? So, we are on track. As of now, we have not reduced the price because we are not seeing the pressure. And today in Hyderabad, if you see still the revenue that we get from, online players is like less than 1% of our revenue. So in fact in Q2, because like when you have this seasonality effect, so we have seen a lot of testing in the basic, in the routine testing also coming back to us. So as of now, we are not seeing any pressure on pricing.
Understood. And if I look at the first half results, our PAT is down roughly 20 crores or around 32%. You did mention, some of the front ending of the expenses. So if I were to just try and quantify the, front ending expenses in terms of employees, OPEX, and, incremental depreciation on some of the newer large centers. So would that all amount to 10 crores of the 20 crore kind of fall? Is that a fair understanding?
Prakash, I just explained this. If you look at the numbers, you might see that the off-year PAT, there is a dip from around 60 crore to 40 crore,
Right.
Because of the pre-operative expenses that I was talking, which is just like a 0.9 to 1% impact on EBITDA, The main reason is, as you know, last year, was like a COVID year, right? In Q1, almost we did 30 crore revenue in the last year Q1, and also in the last year Q2 approximately like a 10 crore. So that's the reason why your EBITDA margin was sitting at almost close to 45.9% in the last year. As we highlighted in a general non-COVID scenario, we expect a regular EBITDA margins of 39 to 40%, what we achieved in the current quarter. So if you see that clearly, there is 6 to 6.2% margin difference is there from the last year first half to the current year first half, which boils down to PAT level. Apart from that, below EBITDA, there is also increase in the depreciation and interest because of the new centers that we added. So last year, post September 2021, we added almost close to 10 new centers. And also in the current 6 months, we added almost close to like 18 centers. So because of that, the interest and depreciation because of India's 116 national numbers also have gone up, which impacted in the PAT from 26 to almost close to 18 to 19%. But broadly, the 6% gap is mainly coming from the EBITDA margin level, which was due to the COVID season in the last first half.
Right. Yeah. So if I add all these notional and the depreciation, it should come to 8-9 crores roughly, if not 10 crores is what I was trying to understand. And lastly, from my side, after 4 quarters, we've seen a sequential improvement in sales and PAT. So, going forward for the balance of the year and in the coming quarters, what are we doing to ensure, this trend continues for us and, we continue to grow on a sequential basis?
So the efforts are always there, and we are track on opening our new centers where we are also going to come up with new hubs in the tier 2, tier 3 towns where you'll get the fresh revenue. right? Apart from that, the focus on the wellness and also with the few digital initiatives, we can increase the efficiencies at our current centers where we are facing the capacity constraints. So I think for the current year, as you were indicating earlier also, because the transition from COVID to non-COVID is happening, so we would be in that 13 to 15% year-on-year growth on non-COVID for the current year, and then going forward, we are sticking to our 15% growth.
Understood. That's helpful. Thank you. All the best.
Thank you.
Thank you. Before we take the next question, participants are reminded to press star and 1 if they have a question. We have a next question from the line of Anish Deora from Nomura. Please go ahead.
Yeah, hi. Thanks for taking my question. So I had just one question. About 6 months back, one of the organized retail pharmacy chains had announced the opening of a full-fledged diagnostic center in Hyderabad, which is one of your core markets. Which is your core market, in fact. So just wanted your comments around whether you consider such openings as a potential threat, or your views about how the competitive intensity is going to play out going forward.
So, Anish, in fact, Vijaya being a 40-year-old player in the market and being the market leader, we are still say we would be less than 20% of the having less than 20% of the market share today, because for every price there exists a market, and these models are not new. Even previously, also we were having other players offering services at different prices. I think in healthcare it's more than pricing. It's about the trust and also the quality of diagnostics, etc. So we have a different kind of clientele, and we believe that we will not either venture into these models, or these models will affect our business.
Got it. All right. Thanks. That's it from me.
Thank you. We have our next question from the line of Priya Harwani from Perpetuity Venture LLP. Please go ahead.
Yeah, thanks. I have couple.
Ms. Harwani, I'm sorry, your voice is breaking.
Hello.
Can you speak, please? I'm sorry, you're not audible. We'll take the next question from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. I wanted to understand, do we have...
Can you please use the handset? Your volume is very low.
Yeah, am I audible now?
Yes.
Yeah, I just wanted to understand, do we have a very good doctor connect in Hyderabad who refer the patients to Vijaya? The reason why I'm asking this question is to just understand, will it be difficult for a new player to take market share away from us because of the relations we have developed with doctors over the years? Or is there any other reason why you think it will be difficult for other players, to take the market share away from us in Hyderabad?
So I think it's not about a relation with the doctor. Like we mentioned earlier, there are two people that we treat as our customers. The first one is the customer who's walking into our center, and the second one who's the doctor who's actually referring that patient. Without certain clinical history, and diagnosis is going to be not complete and holistic in nature. Being in the market for 40 years has created trust just not in the customer but also in the doctors. And like we mentioned earlier, there's a lot of work that we do, that we have made our standards, gold standards, like in epilepsies and PET-CT and oncology imaging. We have more than 120 full-time radiology consultants sitting here, and it's like a tertiary care center. So we do make sure that we, like Shiva mentioned earlier, it's about quality, and we never compromise on that. And if we talk about Panjagutta Center today, a diagnostic center bringing in a walk-in, walk-out dual source CT is the second in India as of today. That's also because of the kind of work we do and the kind of consultants that we have with us. So we do have a relationship both with our doctors and customers That is only because without a proper history, how am I even going to report a case which is probably not possible on an inferior quality of technology or a more lesser experienced kind of consultant sitting in one of the more unorganized or cost competitive kind of sectors.
Right. Okay. And are there any plans to open more centers in Hyderabad, or we have reached the saturation point over there?
I would not say we've reached a saturation, but our concentration is to actually move into remote areas, into Andhra and Telangana and adjacent geographies. Where we do see scope in Hyderabad, we will continue to put a smaller format center. We are not looking at adding any more large hub centers immediately in the near future until and unless we see a capacity constraint. So whatever new hub large format centers will come will be in West Bengal, the adjacent geographies, and in rest of Andhra and rest of Telangana markets.
Right. Okay. And we have been seeing an increasing in the share of our wellness testing, and this trend has been seen in our peers as well. So, just wanted to know from you, what do you think is driving this trend in the increase in our wellness testing?
So there are two things here. One thing I would definitely say is COVID has brought in a lot of change in the mindset of the people itself. That itself is one driving force, just not for us, for the entire industry. They've become healthier, they're thinking better. So that's one. And the second thing that we'll have to see is not just us. If you look at even our peers, you've seen an improvement in this line. Even though we always keep talking about aggregators coming in, you still see that customers prefer to walk into centers where they can put a face, when they can talk to a consultant, and this is actually driving the business. In fact, this was a segment where in I think the Q1 call we had mentioned that we will have to see how this sector will take off. It's actually doing better. We're seeing more walk-ins come in for this wellness, and we're also seeing that we have a larger footfall in this sector because we are integrated. We have both radiology and pathology, and that's giving a more holistic and a full checkup. So we in fact see this growing even coming in near future with the app releasing in December. So we'll just have to wait and see, but we're very confident of this sector growing.
Right. And ma'am, what are the economics like for this bundled packaging? Does it make, company level margins or lower margins? Because if a share of this increases, how will the margin profile change for a company?
I would not say that the margins would be same. They'll be slightly lower, but it would not make a large difference in the overall EBITDA going forward. Probably the pricing would be about 10-15% lower, not greater than that.
Okay. Thank you. That was all.
Thank you. We have our next question from the line of Girish Bakru from OrbiMed. Please go ahead.
Yeah, hi. Actually, going back to same question that probably has been asked before in previous calls, that with these two centers now firing and overall momentum in radiology pretty good, what is the mix that we will see, let's say, 2-3 years down the line, pathology versus radiology?
So, Girish, at a network level, there may not be a big shift. Depending on season to season, you'll see like 1 to 2%, here and there. Because last quarter you've seen radiology at 66, and in the current quarter you've seen pathology at 66, right? But coming to Panjagutta and Rajahmundry, generally hubs are like radiology heavy, and spokes are where you get a higher amount from pathology. So definitely in a center like Panjagutta, so you'll be seeing about 50-55% of revenue coming from radiology. But again, we have to wait and watch, right? And 40-45% of revenue coming from pathology, because they have all the modalities like PET CT, gamma camera, and the high-end MRI and CT.
But realization or general value of radiology is higher, assuming that. So, I mean, what you are saying, if the mix is same, growth in pathology volumes also is very strong. Is that the...
Yes. Growth in pathology is strong. In fact, even if you look at or going up now in wellness will also be a little greater mix of pathology, right? So overall, on a company level, with a few more hubs adding also, we would still say that it would be very good if that ratio gets maintained at that 65-35. 2-3 years down the lane, because you will still see new hubs coming up in new geographies, and they take another 1 year for spokes to come up, and to maintain that ratio of 65-35 is what we try to achieve.
Okay. And just on related this, I mean, given that looking at this quarter, and it's good to see that revenue per footfall is largely to those previous levels before COVID, but revenue per test is still lower. How should one read that then?
No, it's Girish, it's not actually lower. So if you see, we were at non-COVID revenue per test is about 470. Now we are at in this last quarter we were at 460. It's because you have seen the pathology revenue growing in that quarter because of the seasonality effect. Pathology was about 67% of the revenue. That's the reason, and also the other fact is that even in radiology, because we have opened more and more spokes in the last 1.5 years, you've got lot of contribution from basic radiology where the average revenue per test is low. It's more of a mixed change, and where you have seen a 2% change on the average revenue per test.
Okay. And just lastly, when you said you've opened more spokes, these are new spokes largely around these two new hubs, right?
Not these two, Girish. So there would be around more of the newer hubs that you're seeing, like the Rajahmundry hubs and the ones that are coming up in future. I don't know if you told them already, the adjacent geographies, the Gulbargas, and those are the areas that you'll be seeing a lot more spokes add up. Like I told you, we see that when there's an expansion of geography in Hyderabad, or there's a capacity constraint, only then do we add a spoke in the existing geography.
So in the last 1.5 years, the spokes were opened, closer to our existing hubs.
Yeah, in rest of Telangana.
Okay. Understood. Thank you so much.
Thank you. We have our next question from the line of Priya Harwani from Perpetuity Venture LLP. Please go ahead.
Yeah. Am I audible?
Yes. Yeah, now you are.
Yeah. Thanks for the opportunity, ma'am. So I have a couple of questions. Firstly, on your plan regarding addition of labs for the next 2 to 3 years, like you have already mentioned in last 2 to 3 quarters that you will be adding 15 labs per annum. So is this plan, are you targeting the same this time also?
So Priya, 15 centers is a combination of 3 to 4 hubs versus the rest of them being spokes. So the plan is to continue that, and the plan is to continue to open these hubs in the rest of Andhra, Telangana, adjacent geographies, and West Bengal, and we are, I think, going as per plan on that.
Understood. And what would be the capex for our second half of FY23?
I'll let Raju take that.
So, Priya, as we indicated, this year is a different financial year with large hubs like Panjagutta and Rajahmundry. Yeah. So that is why we estimated, in the previous quarter that this financial year's capex will be somewhere around 110 to 115 crore because of Panjagutta and other large hubs. So already for the first half, the capex was approximately 89 to 90 crore. So as per the target, we need to open one more hub and 3 to 4 more spokes, which will add up to the guidance of 110 to 115 crore for this current financial year. But I want to add one more point. So we are targeting other hubs, like as we mentioned, like Kolkata, Gulbarga, Tirupati, which are planned for the next financial year. The work is already going on at these centers. In case successfully we complete these 2 or 3 hubs in the last quarter of this financial year, for accounting purpose, that capitalization might come and sit in this financial year. But that is good to us because the revenue also will start early. So otherwise, for the current year guidance of 15 centers, including 4 hubs and 11 spokes, the capex for the current financial year will be around 110 to 115 crore.
Understood. Just one clarification on the guidance part.
I think you mentioned 13 to 15% growth going forward, is it?
Yes. On the non-COVID revenue, Priya.
On non-COVID revenue. Okay, understood. Just one last question, just sort of curiosity on your Panchagutta and Rajahmundry. How you are seeing demand from last 1 month in these two facilities?
So Priya, Panchagutta we just launched because I think
it's about 8 days.
Yeah.
Okay.
We've just completed the 3rd month, and the numbers are in
line with what we had projected, and in fact there's a lot of demand for high-end testing which we did not expect to see so fast. So I think Rajahmundry is definitely given us good vibes, and it's in line with what we've projected. And Panchagutta, like we've mentioned, it's just been 8 days. Probably I'll be able to give you a better picture, but we're very confident about Panchagutta's growth also.
Okay, that's helpful. Thank you so much.
Thank you.
Thank you. We have a next question from the line of Namit Mehta from KC Capital. Please go ahead.
Hi team, congratulations on a good quarter. Just one question that I had. When you look at opening new hubs, how large must the population be of that town or city for it to be viable? Have you done some sort of calculation around that? Just curious to get a rough sense of that.
Amit, thank you so much. And I would say that probably we don't have a formula, or we don't look at going to a market with that kind of strategy. But we do look at towns where we see they're more like district headquarters, or there's a government medical college where you have about 200, 150 kilometers of population coming into that town, or a smaller kind of city. So if you look at Kurnool per se, we did not look at Kurnool population-wise, but we looked at Kurnool into how much of feeding comes into Kurnool. So we normally look at those, the dense, probably the housing, the affordability of the population in that area, and availability of say 2 or 3 medical government hospitals and 1 medical college. This is something that helps us understand the market and decide whether a hub is feasible there.
Understood. And so if I'm just to take Rajahmundry as an example,
yes.
Can that market take multiple hubs over a period of time? Can that scale up to 2 or 3 hubs within Rajahmundry, or is sort of 1 hub the max that you can go to in a town with maybe 5, 6 hubs?
I would not say that it would take up 3 hubs as of today, but at the pace at which Rajahmundry is growing, probably it will take up 2 more hubs going forward, but it has capacity to take in a lot of spokes. And the affordability is very high in that particular geography. And we don't have a Vijaya center in a vicinity of 200 kilometers. And the technology that is there is something that patients were traveling all the way to a Vijayawada or to a Hyderabad to get that kind of testing done. And that is why we see that the center is ramping up well already. And then you have in a close proximity of Rajahmundry about 5 medical colleges. That is the basic outview of Rajahmundry itself. But if you ask me, ma'am, will you add 1 more hub in the next 1 year? No. We will give that some time for this to actually stabilize, and then probably look at adding 1 more.
Understood. No, thanks so much. That's all from my side.
Thank you. We have our next question from the line of Sudhir, an individual investor. Please go ahead.
Hi. My questions are mostly answered, but I have a couple of questions. Considering the EBITDA margins moderating now close to the pre-COVID levels of around 37 to 40%, can this be considered a sustainable level, or do you think that 40 to 44% that we've seen in the last 2 years is still achievable on a long-term basis? What I'm trying to understand is the cyclicality of the margins. Is it a common phenomenon here?
So, as we informed in the earlier communications, we are quite confident on 39 to 40% sustainable margins, in the long run on non-COVID revenues. So that's what we are confident. And if you talk about, okay, in the short term, okay, there might be a few percentage of drag might be there because, okay, currently we are expanding with large center formats, okay, in and around Hyderabad, like, okay, Gulbarga, Tirupati, Kolkata, okay. So, and also the revenue transition is happening from COVID to non-COVID. So because of these couple of points, in the short term, quarter on quarter, there might be a drag of, okay, a few basis points. But what we are confident is this 39 to 40% sustainable margins on non-COVID revenues going forward.
Okay. So another question is on the, do we have the franchisee model already, or we are yet to have that kind of a model? I am assuming that we have mostly owner-operated model at this point.
So Sudeep, we've done a lot of brainstorming on the franchisee model, but keeping this integrated kind of model with both radiology and pathology, and radiology being a lot in terms of an opinion that we give rather than something that we get like in your lab. We decided to make sure we maintain this quality and have all company-owned centers. But saying that, we are not saying we are absolutely averse to that, but immediately in near future, we've not planned anything, and all of the centers that you see today are company-owned centers.
Okay. I'm asking this question because in the presentation you said you will be leveraging this owner and franchisee model.
Right.
But my question is, how does it all?
We're not planning to do it, but immediately in the near future, there is enough and more than growth that we see for the company to start centers. So we don't have anything concrete in plan, but if there's something that comes up, we will surely do it.
Yeah. So another question pertaining to this, I just wanted to understand how does this order for the current business in terms of margins, assuming your focus. Maybe at a later point in adding the franchising model.
Raju, you would want to know?
If currently, okay, what we're expecting, assuming that all the centers are owned by the company, is around 40% on a sustainable basis. But once we get into a franchisee model, okay, you need to leave something on the table for the other partner. And generally what we have seen is that, okay, there will be a revenue share mechanism, okay, something like 20-25% and then 70-75%, okay. So if you go with this model, okay, for the centers under franchisee model, okay, there will be dip in the EBITDA margins to that extent, okay. But the object of doing that is, okay, to ramp up the revenue in those new markets quick, and also you need not have that management bandwidth in those small format centers. You need not spend a lot of time there, okay. But you can quickly ramp up in those areas if you go with this kind of model.
So one last question. This is regarding the new equipment, the new DLSO CT and the 3T MRI, which you already launched it here in the Panjagutta branch. So I just wanted to understand, having this high-end equipment, will it add to the top line, considering the pricing should get a premium to the 2T MRI, etc.?
See, we are not going to charge anything premium on the price except for few high-end tests which are not available in the current network. So on the top line, yes, definitely, Panjagutta is going to contribute a good chunk of revenue in the coming years in the span of next 3 to 4 years. But on the pricing front, only few tests are where we are going to have a differential pricing. But all other regular tests will be like normal, like any other branch.
Okay. So will this, this new equipment, this high-end equipment, will be eventually rolled out into the other reference or hub labs? Eventually, is there any exclusivity to Panjagutta branch? Or since this is a costly equipment, and probably the rentals should also be on the higher side if the equipment is not on the rental.
So as of now, Sudhir, it's only for Panjagutta branch. See, because first of all, Hyderabad itself has got that equipment today, right? And the best part of this equipment is the number of scans. The throughput of this machine is high. For example, if you're doing something like 10, 15, 20 scans on a regular machine, you'll be able to do perform the scans quicker with 35 scans per day. where the revenue output for each machine, there's a lot of difference.
Also, more than that, Sudhir, it's the safety of the patient. This dual source walk-in, walk-out CT, basically CT scan is known for little amount of radiation. This is very, very negligible radiation to the patient. So in terms of safety, this is the best equipment that you can have as of today.
Okay, thank you. That's all from my side, and congratulations for the good set of results.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have our next question from the line of Anish Deora from Nomura. Please go ahead. Mr. Anish?
Yeah, hi. Am I audible now?
Yes.
Yes, Anish.
Yeah, thanks for allowing the follow-up. So I see the revenue per test is around 460 rupees. I just wanted a sense about how this varies for the radiology and the pathology segment separately.
So generally, revenue per pathology test would be in the range of say 330 to 350, and for radiology it will be something like 1150 to 1200.
Understood. Okay. And could you just also give a sense on how the EBITDA margins vary between these two segments?
We don't look at a center like that, Anish, at all. For us, it is one center, one customer, one prescription. So we've not been able to do a differentiation on EBITDA margins because it's all shared costs. When a customer walks in, it's the same biller who will be billing both for pathology, radiology. It will be the same staff nurse being utilized for both.
Center
overheads are all shared. So it's difficult to give you on EBITDA margins in that format.
Got it. All right, helpful. Thank you. That's all from my end.
Thank you. As there are no further questions, I now hand the conference over to management for closing comments.
I would like to thank everyone for attending this call and showing interest in Vijaya Diagnostics. I hope we were able to answer all of your questions. Should you need any further clarification or seek to know more about the company, please feel free to reach out to us or to CDR India. Thank you all once again, and I hope to see you next quarter.
Thank you. On behalf of Vijaya Diagnostic Center Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.